That salary offer sounds exciting, but let's slow down for a second. How much of that money do you actually keep after taxes and deductions? In this video, we're breaking down what your real take-home pay looks like in Canada. Welcome to Maple Money Talks. This is where the numbers get real. Before we talk numbers, let's understand how the system works. Canada's tax system has three main parts working together: federal tax, provincial tax, and payroll deductions. When people say taxes are high, they're usually talking about all three combined. Federal tax uses progressive rates based on income. Provincial tax depends on where you live and adds another layer. On top of that, payroll deductions like CPP and EI are taken automatically. So your total tax isn't just 1%, it's the combination of all of these. Let's talk about CPP first. CPP is a mandatory retirement savings program for working Canadians. If you're between 18 and 70 and earn more than $3,500 a year, you contribute. In 2024, you pay 5.95% and your employer matches it. You don't see this money now, but it's being saved for your future. Next is employment insurance, or EI. EI provides temporary income if you lose your job through no fault of your own. It also supports maternity, parental, and sickness leave. You contribute 1.66% of your insurable earnings. Think of EI as insurance built directly into your paycheck. Now that you understand the deductions, let's look at real salary examples. This is where most newcomers get surprised. Gross salary looks great, but net pay tells the real story. At a $50,000 salary, your gross income sounds solid. But after federal tax, provincial tax, CPP, and EI, your take-home pay is about $40,000. That's roughly a 20% total deduction. This gap between gross and net shocks a lot of first-time workers in Canada. At $70,000, deductions become more noticeable. You take home around $49,700 a year. That means about 29% of your income goes to taxes and contributions. Each additional dollar you earn is now taxed at a higher rate. Hitting six figures feels like a big win, but after all deductions, your net income is closer to $68,000. About 1/3 of your income never reaches your bank account. This is why budgeting based on gross salary can be misleading. Here's something many people misunderstand. Not all your income is taxed at the same rate. Your first dollars are taxed at lower rates. Only the higher portion is taxed at higher rates. This is called your marginal tax rate, and it matters when planning raises and side income. Let's clear up a common confusion. Gross pay is what you negotiated and what's on your contract. Net pay is what actually hits your bank account. Taxes, CPP, and EI are already removed from net pay. Always plan your life using net pay, not gross salary. The good news is, there are legal ways to reduce your taxes. RRSP contributions lower your taxable income dollar for dollar. Tax credits like tuition, medical expenses, and donations reduce the tax you owe. Deductions such as work-from-home expenses can also make a big difference. Not all tax credits work the same way. Non-refundable credits reduce taxes owed but won't create a refund. Refundable credits can give you money back even if you owe no tax. Knowing the difference helps you maximize refunds and benefits. Many refunds are delayed because of simple mistakes. Missing T4 or T5 slips, forgetting RRSP receipts, ignoring medical expenses, or using outdated direct deposit information. Accuracy matters more than speed when filing taxes. Taxes feel high because they fund healthcare, education, infrastructure, and social programs. Most individuals must file their taxes by April 30th each year. If you can't pay what you owe, still file on time. The CRA offers payment plans, and late filing penalties are much worse than late payment penalties. The biggest takeaway is simple. Always plan your finances based on net income, not gross salary. Calculate your real take-home pay before accepting job offers. Budget with what actually hits your bank account. Understanding your taxes puts you in control of your money. That's how you build confidence and financial stability in Canada. Follow Maple Money Talks for more simple, real-world money guidance in Canada.